So thank you so much for stopping by again. This is the chapter 9, the second half. I believe we did hear last time up to this point. You can again read it if you forgot. But let's see what is after this. So it looks like we are looking at a Schedule E, how it looks like. Here it gave us some information for Schedule E. So if you take those information, like revenues, expenses, the address, everything, and you transfer this into a Schedule E, it will look like something like this. So it's a Schedule E at the top that will end up in Form 1040. You have, let's say, the property address, A, B, C. At least you have 3 of those addresses here available. So you show all those addresses. And type of property, so what type of property it might be. Let's say if it's a single family residence, you call it number 1. If it's a multifamily, you call it 2. It's a vacation or short-term rental, you call it 3. And commercial, you call it 4. Land, it's 5. Royalties, it's 6. Self-rental, and 8 others. So if it's just flat land and you rent the land, remember, you can rent a land and have rental income, but you don't depreciate the land unless you have land improvements. If you have land improvements, then you depreciate. What is land improvement? Including like lighting, sprinklers, green areas, that you have sprinklers on it, concrete, asphalt, driveway, something like that you make your land usable. In that case, it will be land improvement and you need to depreciate the land improvement, but you cannot depreciate the land itself. So here we say, okay, the property A is a number 3, let's say vacation home, rental, and property number 2 is type 2, which is multifamily residence. And then you enter fair rental days, whatever it is, fair dental, rental, personal use, 30 days. The multifamily is 365 days. That means it was rented all the time. And then you show the rent received for property A and B, the advertisement that you spent for each property, cleaning that you spent for each property, insurance, mortgage interest. And again, that mortgage interest, how much you can deduct depends on that fair rental days. Remember, we covered that last time. And also taxes, utilities, and depreciation, and other stuff. So as you see, you add up all those revenues and minus all those expenses, and then you end up to the point that line 26, it shows that how much rent income you have or lost, and that will be transferred to Form 1040. Okay, so this will be done normally by your software, and you don't need to do it manually. That's crazy, right? Okay, what is at-risk rule? Let's read it a little bit. So when rental expenses exceed rental income, so if expense is higher than income, and the rental property is considered as a residence, the tax law limits the amount of rental expense that you can deduct. Remember, we said you can deduct up to your rental income, the rest will be carried forward. For the rental property not considered a residence, two other sets of rules may affect the taxpayer's ability to deduct losses coming from that rental activities. The at-risk rule and the passive activity loss rule. So we have two rules for that. What are those? These rules not only affect rental activities, but also can affect losses arising from any trade, business, or income-producing activity. The at-risk rule are discussed first, followed by passive activity loss rule. The at-risk rule limits a taxpayer's loss to amount of taxpayers' actual losses, that is the out of pocket. Out of whatever you really have a loss out of pocket, that's your at-risk loss. This is known as the amount that the taxpayer is technically at risk. The at-risk rule applied to any activity carried on a trade or business reported on Schedule C, or for production of income reported on Schedule E. So at-risk rule, it will apply to Schedule C or Schedule E either way. So that is kind of common. A taxpayer's risk is in any activity equals to what? Equals to the following. One, the money and the adjusted basis. What is the adjusted basis? The cost plus improvement minus anything that has been depreciated so far, which is accumulated depreciation. So cost of whatever you put in plus any improvement you put in minus any depreciation you took. Plus amount borrowed for use in activity if the taxpayer either is personally liable for the loan or pledge personal assets to back up the loan. So if you put some money in a business, you did some improvement, you add them up, minus whatever you depreciate, that is your at-risk rule. But if you go and borrow money and you are personally liable for that borrowed money to put in the business, that borrowed money will be also added. Got it? So whatever, and that says how much you are at risk. If you are at risk for putting some money in the beginning plus some improvement, but you took some depreciation expense as a expense before, so you have to deduct that. Plus, if you borrow money to put in the business or in the Schedule E rental activity, but you are liable for it personally, then that is also included in your at-risk group. Taxpayers that suffer a loss from an at-risk activity determine their deductible loss on Form 6198 at-risk limitations. So you take loss up to your at-risk amount. Taxpayers can only deduct losses to the extent they have amounts at risk. Taxpayers' amounts at risk decreases when they deduct losses from the activity on their tax returns and when they take withdrawals from the activity. So if you start recognition of losses, then your at-risk goes down. The at-risk amount will be reduced. If you take withdraw, also it will reduce your at-risk because it is reducing your basis, the basis that you put in that business or in that rental activity. So that's why you have to keep the track. What is at risk? What did you put in? And if you borrow money, are you personally liable? If yes, then that is also at risk. Taxpayer can only deduct losses to the extent they have at risk, taxpayers' amount at risk decreases when they deduct losses from the activity on their tax returns, and when they take any withdrawals from the activity. Withdrawals, that means you take money out of that activity and go vacation. That's a withdrawal. That means you use for your personal joy. So it's a withdrawal. In years when the taxpayer's losses is less than the amount at risk, the taxpayer can deduct the entire loss, or maybe a year, 2 years, 3 years, 4 years. And the amount at risk is reduced by the loss deducted as it goes year after year, whatever you deduct. The reduced at-risk amount becomes the taxpayer's amount at risk for the start of next year. So your basis gets adjusted. So there's an example here. In 2021, William starts his own business by contributing $10,000 from his personal funds and by getting a $100,000 interest-only loan. William uses his personal assets to secure the loan, let's say his home. William's initial amount at risk is $110,000. During the 2021, the business suffers a $60,000 loss. William can deduct the entire $60,000 loss on his tax return. That's okay. However, his amount at risk is reduced to 50. So his basis is going down. In years when the amount of the loss exceeds the taxpayer's at risk, the taxpayer's loss deduction is limited to the amount at risk, not more than that. Any disallowed loss carry over to the next year. Since the amount at risk has been reduced to zero, no future losses will be allowed until the taxpayer gets a positive amount at risk. How do you get a positive amount at risk? That means you put some more money in the business, or you borrow more money and you put your personal assets as a backup, and you put that money in a business. That way your at-risk zero balance goes up by dollar amount that you put in the business. And then you can, again, recognize the disallowed loss that you didn't recognize before. This can be done through a variety of means. For example, the taxpayer could make additional investment in the activity, or have the activity take out a loan for which the taxpayer is personally responsible. So the same example, in 2022, William business suffers another $60,000 loss. So since William's amount at risk is only 50 at that point, he will only be allowed to deduct 50 for 2022 losses. He carry over the $10,000 disallowed loss to 2023. Yes.
Let's say after that scenario, he loses another 30,000. Would it just fizzle out, or would it carry over to?
Again, it will be disallowed and he has to carry over until he is in the situation that he gets a big loan or something and he puts his personal assets as a backup. Then all of a sudden we have at risk zero, goes all the way higher amount, whatever borrowed amount is. And then he can start deducting that disallowed losses that he was just carrying forward at that year to recognize loss again. Okay, that's at risk, and that applies to a business, applies to rental property. So the idea was, if I go back, remember we said if it's a residence, then you cannot deduct and you have to carry forward, right? But if it's not a residence and it is a real full-time rental activity property, right? Then you have to follow the at-risk rule, right? And also you have to look at the passive activity rule. After applying the at-risk rules, taxpayers must consider the passive activity loss rule also. So losses generated by activities of a passive nature can only offset income and gains generated from passive activities. Taxpayers carry over excess passive losses to offset passive income in future tax years. When the taxpayer disposes of entire interest in a passive activity, any suspended losses left from that activity are fully deductible in that year. So the only moment that you can take all the loss in fully in that year is when the taxpayer does what? Dispose the entire interest in that passive activity. So that is the keyword, I believe. So if you have a passive activity, it says losses generated by a passive activity can only offset income and gains generated from passive activities. So you have to have enough income to recognize that. But you can just keep that passive activity going for year after year after year till one day you sell that property. And because the whole property is gone and you have so much loss from that passive activity, then you recognize it as entirely. The whole loss will be recognized in that year. So you have to sell the property to recognize the loss. Make sense? And just so you know, in most cases, when you sell the property, there is a big chance that you have a capital gain anyway. And capital gain by itself is a type of passive activity because it's just a capital gain. Active, that means when you are real, let's say in a real estate, you're active if you are a real estate broker and your job is to manage properties, buying properties, renting them. That's your job. Then you are not passive anymore. But if you have another job, but you have a rental property and you rent it out, that is a passive activity, so-called. Make sense? Okay, so passive activity income defined. What does it mean anyway? The passive activity rules classify all incomes and losses as coming from one of three types of activities. Either active, something that is active, some portfolio, or passive. So active income consists of wage, salary, something that you work for it. Income from material participation, that's a keyword. Material participation is the keyword in trade or business. So that's an active income, which is normal. We understand that. That means you are working for it. Portfolio income comes from investment that generates dividend and interest. So portfolio income also includes gain from sale of securities and bonds. So portfolio income, let's say normally I have at the end of the year, I have some dividends, I have some interest, and also I have some short-term gain or loss because I sold some of my stocks in my portfolio. So those are technically, portfolio income, and it is kind of considered as coming from your stock, bonds, those type of things. And you have a capital gain, either short-term or long-term, or capital loss. Passive income comes from what? Comes from trade or business in which the taxpayer does not, here is the word, does not materially participate. If you don't materially participate, then it's a passive. like rental activities also can be a passive. A limited partnership. If you are a partner in a limited partnership and you are doing technically nothing, you are just a limited partner and someone else, the general partner, is making all the decisions and working and running the business, then you are a kind of passive partner. So it comes either from a business that you are not materially participating, like you are, you have a business, but someone else is running for you. Rental activities, which you just, most of the time, you just collect the rent. And if something is not working, you call someone to fix it. Any of these three types of activities may produce losses, right? And losses from the sale of portfolio investment are capital losses. However, losses not classified as portfolio are either active or passive. So if it's not from portfolio, then it should be either active or passive. Active, that means materially you're participating, and passive, that means you do not have material participation. The distinction is important, as taxpayers can offset losses from active activities against both portfolio and passive. So that's a good thing. So if you have active activity and you have a loss, you can use that loss to go against portfolio or passive income. They can only offset losses from passive activity against they can only offset losses from passive activities against income from other passive activities. So passive activities, the bad thing about it, if you have a loss from passive activities, you have to wait till you have a loss from a passive activity again, till you write off your passive activities. Make sense? So I had, let's say, some passive activity losses I was carrying forward for many years in my tax returns. And then it got to the point that I started using it to write off against another passive activity. Material participation in a trade or business produces active income and losses. So it's a very important word that you can prove to IRS that you have a material participation in that trade or business. So you can say it is an active income or loss. So material participation happens when the taxpayer is involved in the operation of activity as a regular, continuous, daily basis, except for rental real estate activities, which must meet a stricter test. So IRS is very picky about the rental because you are trying to say, no, I'm actively doing things, but IRS has much more stricter tests. The material participation requirement can be met if the taxpayer participates in activity for more than 500 hours during the year. You know how many hours you work for a year?
2,080 full-time.
Yeah, the average, they say 2,000. So that means you have to work for 500 hours to say, yes, I am actively working. And I am materially participating. For purpose of 500-hour test, participation by the owner's spouse is considered participation by the owner. So if you are doing 250 hours and your wife is doing 250 hours, then combined is 500, so that's fine. Another way to meet this requirement is for the taxpayer to participate in the activity for more than 100 hours during the year, and for the taxpayer's participation to be at least as much as the participation of any other individual, including employees. So let's highlight that. here. Another way to meet the requirement for the taxpayers to be participating actively is to have more than 100 hours in 1 year and to be at least as much as the participation of any other person, including employees that you have. So if you have an employee, he works 100 hours and you work also 100 hours, that's an active participation. But if you have an employee that works 150 hours in 1 year and you work 100 hours, that's not gonna make it. So there is IRS publication to see the requirement. So here's an example for this tricky part. Jeannie and Barry jointly own and work for a business that does not involve rental activity. Okay? Jeannie also works part-time as an employee. Jeannie and Barry are not married to each other. During the year, she works 425 hours for the business and 600 hours as employee. Barry is not employed elsewhere and spent 40 hours a week working for the business. So it looks like Barry is doing most of the job. Because his hours of participation exceeds 500 hours, Barry materially participating in the business. Jeannie does not participate in the business more than 500 hours. And although her hours exceed 100 hours, which is good, however, her hours do not equal Barry's hours. It should be equal to Barry's hours, but Barry is working a lot of hours. So thus, unless she can meet the material participation requirement another way, the passive activity loss rules will apply to Jeannie with respect to this activity, but not to Barry. If Barry and Jeannie were husband and wife, each would be able to count the participation of the other, So in that case, it would be what? Many hours for Jeannie plus Barry. They are more than 500 hours. They are good to go.
But they have to file joint to be able to participate.
They are friends.
They're only friends.
Yeah, they are not married or something. They're just friends and they have a business or something.
Oh.
If Barry and Jeannie were, let's read that. If Barry and Jeannie were husband and wife, each would be able to count the participation of the other. The total participation of couple would be Barry's 2,080 hours, because 40 times 52, plus Jeannie's is 425. Whatever she told me. Yeah, 425. Same fact as example 16, except that Jeannie averages 10 hours a week working for the business. Okay, since Jeannie is working 520 hours, 10 hours a week, exceeds 500 hours requirement, she materially is participating in the activity. Therefore, the business would not be considered a passive activity for Jeannie. So it's good to know about this because it will apply to business, it will apply to rental activities. So it's good to know about this, that how much you are spending money, spending time for that specific activity to be determined if it is passive activity or active activity. The tax law treats most rental activities as what? There you go, that's the tricky part. So IRS wants to say that rental activities are different things. However, exceptions do exist. One exception applies to taxpayers involved in the business of renting. You are involved in the business of renting real property. This situation is described in section 90502. Three other exceptions include rental activities where the average rental period is less than 8 days, like 2 rental stores. The average rental period is less than 31 days, and significant personal services are provided, like motel and hotel. And the rental activity is incidental to the taxpayer's business. Unless one of these four exceptions apply, losses from the rental activity will be considered passive losses. So most of the times, normal client that they have a rental property, they are passive activity. Okay, rental real estate losses. What do you do with them? The rental real estate activity usually are treated as passive that we just covered, even if one of the 7 ways for meeting the material participation requirement has been met. However, a rental real estate activity may qualify as an active trade or business if the taxpayers satisfies both the following situations. You have to satisfy both of them. Number one, more than 50% of personal services rendered during the year are performed in a trade or business involving real estate. So you have to be in the real estate business legally. At a minimum, the taxpayers performs more than 750 hours of personal service in the real estate property trade or business. Okay, so that's also means you have to be in the real estate. If taxpayers passes both tests, then the rental real estate activity is not considered passive, and any losses from the activity would be fully deductible against ordinary income, subject to at-risk limit described in 904. Like I have a real estate license, sales license, and I was actively participating at buying rental properties, sell them, rent them. So at that point, any loss was active real estate activity, active loss, which I could have write it against my other losses, whatever I might have, or other incomes, whatever I might have. So the loss would be able to eliminate the income that I have from any activity because it's an active loss. A married couple passes the 2 tests only if one spouse separately satisfies both conditions. In other words, couples cannot pool their time and efforts in the meeting the 2 conditions for the rental activity. So we cannot put our time together. If one of them is a real estate broker and working in the real estate, that's fine. But you cannot say, oh, let's put our time together for real estate purpose. If these conditions are not met, then the rental real estate activity is considered a passive activity. And we have few examples here, so let's look at them. Same facts in example 17, except that Jeannie and Berry business involves rental real estate properties. Berry performs more than 750 hours of personal services in business involving real property. In addition, that means he's a broker or something, right? In addition, this work is more than 50% of his total hours of personal services rendered during the year. Therefore, Berry materially participates in the rental property business. Jeannie's hours, on the other hand, do not exceed 750. Therefore, Jeannie is not materially participating in the business. Accordingly, the business is a passive activity for Jeannie. A husband and wife work 400 hours in a rental real estate business. Although as a couple, they work more than 750 because 400 plus 400 is 800. However, IRS is picky, says no, the tax law says you cannot combine. So at least one of them has to meet the requirement of 750. You cannot combine the hours. So it's a passive activity for this husband and wife situation. The taxpayers has the burden of providing proof that any personal service tests have been met. To do this, taxpayers should keep a daily log of their hours spent on the activity to prove their hours of participation in activity. Remember I said IRS is picky about mileage log, and you have to have a very good mileage log to win the argument. Same thing in here. You have to have a really good activity log so you can prove your argument that I am actively participating. So if you are not actively participating, then it's a passive activity and you can only write off that loss against any other passive income. Make sense? But what is 25,000 special deduction for active participants? So taxpayers who are not a real estate agent and have losses from rental real estate activities may be able to deduct up to how much? $25,000 of rental real estate losses from active and portfolio income. So IRS says, okay, you are not a real estate agent, you are not in real estate business, but you have rental income, rental activities, and all of a sudden you have loss. Okay, up to 25,000 you can use to wash any active or portfolio income. The deduction limit is 12,500 for married filing separately. That's another issue for doing married filing separately. No special deduction is allowed for married taxpayers filing separately if the couple live together at any time during the year. To qualify for this special deduction, the taxpayer must meet both the following requirements. So number one, taxpayers actively participate in the rental real estate activity, and taxpayers own at least 10% of value of the interest in the activity throughout the entire year. So they have to be at least 10% owner, and also they have to have active participation. Active participation and material participation are two different concepts. So material participation is much more stronger. Active participation requires less involvement than material participation. So those are two words that you need to remember: active participation and material participation. Active participation does not require regular, continuous, and substantial involvement. Like someone that has a rental property, sometimes you need to take care of your property, sometimes something is broken, you have to go there, you have to go collect rent, you have to find someone, you have to negotiate someone to fix it, you have to negotiate your rental tenants agreements, all those type of things. That is a regular active participation that you do as a landlord. But material participation, that means you are in real estate business all the time. However, it does require that the taxpayer participate in management decisions, which I just explained. Like approving tenants, deciding rental terms, approving improvements, repairs, arranging others to provide services for repairs, those type of things. So going back to example 18, although Jeannie's hours do not constitute material participation, they do indicate active participation, because she's at least working there, right? She's making decisions, she's finding tenants, those type of things. So since Jeannie owns at least 10% of business, she qualifies for up to $27,000 special deduction against what? Against any other income she might have, any other income. Therefore, in years in which the activity produces a net loss, Jeannie may be able to deduct up to $25,000 of her share of the loss against her active and portfolio income. The $25,000 annual deduction is reduced by 50% of the taxpayer's modified AGI in excess of $100,000. $50,000 for married buying separately. Therefore, the deduction is completely phased out when modified AGI reaches what? 150, because it's reduced 50% of if taxpayers' AGI goes above 100,000. So by the time it reaches 150, the whole thing is gone. In computing modifying AGI, passive losses cannot exceed passive income. Modified AGI is any passive activity loss of taxpayers in a real property business without the following items. So what is the modified AGI? Modified AGI is your AGI, but without any passive income or loss, without rental real estate loss allowed to real estate professionals, without any overall loss from publicly traded partnership, without any taxable amount of Social Security and railroad retirement benefit, without any deductible contribution to IRA, without any deduction for foreign derived intangible income, without the exclusion from income of interest from Series EE and US saving bonds, without the exclusion of amount received under Employees Adoption Assistance Program, without student loan interest deduction, without tuition and fees deduction, and without deduction for self-employment tax. So you have to take all of those out of your AGI in order to get to your modified AGI. So if you reach to your modified AGI and your modified AGI is over $150,000, you cannot deduct any of that $25,000 annual deduction for active participation. Okay, so here is the example for this. Rachel, a single taxpayer, earned $110,000 from her job. $15,000 of passive income from a non-real estate activity, and $20,000 of interest income. Okay, so 110, 15, and 20. Rachel also incurred $50,000 loss from a rental real estate activity in which she actively participated, not materially participate, but actively participate, which most people normally do. Rachel made a $6,000 deductible IRA contribution in 2022. Under the general rule, passive losses usually can offset only passive income. Therefore, Rachel can use $15,000 of her 50 rental real estate loss to offset that $15,000 of the income from the non-real estate passive activity. That's good because you can use non-passive losses against passive income, so you pay less taxes. That's good. Because Rachel is actively involved in the real estate activities, she may be able to deduct more than 15. Remember what was the number? The number was 25,000. Rachel computes the additional deduction on passive losses carry over as follows. So she has $110,000 of wage. The interest income is 20. So modified AGI ends up to be what? 130. So wage plus interest income. That's modified AGI. Less AGI threshold for the phase out, which is 100,000. So amount subject to phase out is 30. 50% of 30, whatever is above 100 on modified AGI, that's amount of deduction loss due to phased out. That's 15,000. So $15,000 deduction loss because of that phase out. So 30 times 50%, $15,000 is gone. Okay, so we lost that. Because Rachel's modified AGI exceed 100 by 30, she must reduce the $25,000 deduction for active participants by 1/2 of the excess, or which is 15,000. So she has $25,000 limit to use, but that $25,000 limit will go down by this calculation that we just did. So 25 minus 15, therefore Rachel additional passive loss deduction is only $10,000. So excess passive loss from rental real estate is $50,000 minus 15, which we talked about this year. Remember, we have 15,000 passive income, right? That $15,000 passive income, you can use against here, $50,000 rental real estate. So here we go. Excess passive loss from rental real estate, $50,000 minus $15,000. That is passive income. So your passive loss left is only 35. So technically you have to carry this forward, right? Because you cannot deduct it anymore. However, because she's actively participating, we just calculate that she has another $10,000 a year to use. So she's going to use that. Additional passive losses deduction for active participation in real estate is that $10,000. So we're going to use that too. It could have been 25,000, but the modified AGI is high. That's why it's only 10. So passive loss carried forward to next year is $25,000. Make sense? What we are doing here? Anyone is not following us? We are good? Okay. Modified AGI does not include the $6,000 IRA deduction. Remember, those are things that you have to take it out of your calculation. On the $35,000 passive losses in excess of passive income. Rachel will deduct a total of $25,000 passive activity losses, which is 15 from general rule and 10,000 from special passive activity rule. Of that amount, $15,000 will offset passive activity income, and the excess $10,000 loss will reduce Rachel's active and portfolio income. So she has to carry forward in this situation. $25,000 passive loss carry forward to future till one day she can write it off against a passive income. If for many years Rachel doesn't have a passive income, then this $25,000 passive loss will keep going forward till get used one day. And this is the reason that you want to use the same software, so the software will carry forward for you. If you change your software and you use another thing, then you have to kind of look at the last year tax return to see if there is any passive loss carry forward in the previous tax year, so you can kind of bring it to this new software that you are using. Passive activity losses does not deduct in the current tax year carry forward to the next year. So if losses does not deducted in this year, you carry forward to the next year. Passive losses that are carried forward must be allocated among the various activities that produce the loss. When multiple passive activity exists, taxpayers must determine the suspended loss for each separate activity using the following formula. So disallowed loss, whatever it is, multiplied by loss from separate activity, divided by sum of all losses. So loss from separate activity out of all losses gives you a ratio. And you multiply that with disallowed losses to get that specific activity loss that you are carrying forward. So here is the multiplication. Dennis report the following income and losses from his 4 passive activities in 2021. Activity A, $40,000 loss. Activity B, $30,000 income. Activity C, $32,000 loss. Activity D, $8,000 loss. Net passive loss is 40 plus 30 minus 32 minus 8. That's $50,000 net passive loss carrying forward. Dennis allocates his $50,000 net passive loss to activity A, C, and D. A, C, and D, because they have loss, so you have to allocate that. They are combined producing 40 plus 32 plus 8, that's $80,000 of loss. So that's your denominator, right? So activity A is 50 out of $50,000, activity A, $50,000 this, of total loss, net passive loss. For activity A is multiply 40 out of 80. 40 out of 80 gives you a ratio of 50%. 50% times $50,000 loss. So activity A is carrying forward how much? $25,000 loss. Activity C is 32 out of 80, gives you a ratio. Multiplied by 50 gives you $20,000 loss that you are carrying forward. So activity A is 25, activity C is 20, and activity D is 8 out of 80, which is 10%. 10% of 50 is 5,000. So now you know exactly which activity, how much loss they are carrying forward to the next year. Yes, I know the total is still 50, but you need to know how much each activity is carrying forward separately, not combined in one package. These suspended losses carry forward indefinitely as deductions associated with the activity to which each relates. Thus, the $25,000 passive loss carry over associated with activity A is added to or netted against any passive income or loss generated by activity A in future year, which is 2022. This net amount becomes Dennis' passive income or loss from activity A for 2022. The same process applies to activity C and activity D. So now if you have 2-3 different activities, you have to have a very good understanding of which carry forward loss belongs to which activity and how much dollar amount. But remember, we were talking about disposing. So when taxpayers dispose of any passive activity, any suspended loss relating to that activity are deductible in full. So this is a good word to highlight. It's very important. So let's do that. So let's say in here, for example, activity A, it's disposed in next year. If activity A is disposed next year, then the whole $25,000 can be used because it's disposed already. To qualify for this treatment, taxpayer must dispose of their entire interest in the activity in fully taxable transaction. Also, the new property owner cannot be the taxpayer's what? Relative. Special rules apply when taxpayers dispose of a passive activity by way of gift or inheritance. These rules are beyond the scope of this textbook, so it will get a little bit complicated. You have to go to publication to see what's going on because it's a gift or inheritance, and now you have a activity loss in related to that specific activity. Passive loss in related to that specific activity, and it is more complicated than this book. The gain or loss from the sale of passive activity receives special treatment. If a loss results, the loss is either an ordinary loss or a capital loss. So if you are selling the passive activity, you have a gain or loss, right? You might have a gain, you might have a loss. So it's a special treatment, it says. If a loss results, the loss is either an ordinary loss or capital loss on the circumstances, depending on the circumstances. The loss is not treated as a passive loss, so it's not limited to offsetting just passive income. Chapter 11 explains the difference between ordinary and capital loss in greater detail. So let's look at this example. Dennis sells activity A. Remember activity A right there? Any part of 25,000 passive loss carrying over from 2021 that is not utilized in 2022 to offset passive income and gains is deducted against Dennis' active and portfolio income. And the reason is because he's selling all of it. Make sense? Taxpayers with income or loss from passive activity complete Form 8582, passive activity loss limitations to compute amount of passive loss allowed for such activity. Taxpayers then report the passive loss allowed on the appropriate tax form or schedule. For example, taxpayers report passive loss allowed for rental activities on Schedule E. If it is business activity, then it is, let's say, Schedule C. So let's move on. This is an example again, Form 8582. Those are the situations. And let's look at the form itself. So here is a passive activity loss limitation. So rental real estate activities with active participation. Active participation, that means you are a landlord that are actively participating in renting and those type of things. You are not material participating, but actively participating. So activities with net income, 10,000. Activities with net loss, enter the amount from part 4. It will get updated and combined. You will see either positive or negative number right there. And all other passive activities, if there is any other than that, that 15 will go down here. Part 2 is a special allowance for rental real estate activities with active participation. And that is where you are saying, let's say how much AGI, modified AGI you have, and if there is any limitation. Okay, so we're gonna skip that also. You can look at it later on. It will be prepared with your software, so you don't need to do it manually. This is the Schedule E. Here is a property A, as you see. They have some income and they have some expenses. And you see the total expense is $32,000. So 32,800 minus 7,800 income. Oops, they have $25,000 loss. You see that? Anyway, so that loss will depends if it is active participation. You can have up to $25,000 loss deduction against any income you have, assuming your modified AGI is below $100,000. Qualified business income we covered in previous chapter, but if you have rental activity, that is also qualified for QBI. So a rental activity is eligible for QBI deduction, and QBI deduction, qualified business income deduction, is 20%. Remember that, 20%? It goes in Form 1040 at the bottom to reduce your income. So if the owner's activities are sufficient for the enterprise to be treated as a trade or business under general tax law, you can use QBI. Many cases have held that an owner who actively manage a rental property, even one single family home, is carrying on a trade or business. On the other hand, the owner of property subject to triple net, that's a little bit complicated, like commercial type of properties, lease in which the tenant pays for maintenance, insurance, and all other necessary costs, is not engaged in a trade or business, but holds the property as a mere investment. So triple net, that means mostly happens in commercial real estate where you lease as a triple net. Nor is it necessary to meet the standard. Okay, so we got that idea. So QBI will apply to real estate activities also. And here is the QBI form that it will be calculated. So here is the property, looks like $10,200, and up to 20% you can put it in the 1040 as a QBI. And here is the threshold, but assuming this person is less than that, so 2042, which is 20%, will be the QBI. And that goes in Form 1040 right at the before taxable income is shown. Okay, so we are good for today. Hopefully you like it, and we will try to prepare some taxes.